So that brings us to an introduction to dividend tax. Dividend tax will go live on the 1st of April. It's not an April Fool's joke. The legislation was signed off before New Year. We have got 3 months notice that it's coming, but at this stage we don't have the forms. And we've got to look at it and put it all in context and see what it's about, what we can leave for the nerds, the researchers, and the board exam candidates, and what is actually substantial in our lives. This will take about 45 minutes to get through. Currently we have STC. And the first question must be, why change? It's taken us 20 years to learn how to use it and abuse it. And now we want to change all the rules just for why. And there needs to be a whole history in this thing. One has to first of all put it in context as to how big it actually is. This is a graph I'm going to use over and over again this morning to illustrate the problems of South Africa. 36% of taxes come from the individual taxpayer, 252 billion rands a year, and that is followed straight away by VAT, 28% of total taxes. So before you even start, the individual is paying about over 60% just in the first 2 taxes. Corporate tax has declined for 2 reasons. One is that profits are not so good post the global credit crunch, and the other is the drop of the tax rate to 28%. That we can talk about maybe in a little bit more detail later. Then they go back to the individual and they clobber them with customs and excise duties and sin tax. If that's not enough, fuel tax. And then only do we come to STC, currently collecting 18 billion rands a year. And it will probably decline to 10 billion rands a year once dividend tax is in, because of the exemptions that are in dividend tax that are not in the current STC system. So when you talk about 10 billion, we can get that, that's the equivalent of cigarette taxes, okay? It's not a major thing. It's failed plenty of board exam students because it's nice and complicated. One often thinks, why should we bother? And then there are the other little taxes, CEDA levies, transfer duties, and the like, which make up the rest of the pie, but they're pretty insignificant. So it isn't the greatest tax, and it's going to get even smaller, but now we have to revise the whole thing. Why? Well, let's go back into the history of dividend tax. And we see that years ago, in fact, I was the last student who had to endure the partial taxation of dividends and undistributed profits tax. If you could pass the board exam question in that year, you could call yourself a chartered accountant. It was demented. And not even SARS officials could get it right all the time. Everybody failed that one. That was so complicated that the Minister of Finance in the closing years of the new South Africa, Barent du Plessis, he couldn't understand it either. So he said, fucked it, and he somehow deleted it out of the Tax Act, okay? And we lived without a dividend tax for a couple of years. But that was not sustainable from a couple of points of view. One is it drove up the corporate tax rate. 2, it encouraged the distribution of cash out of companies because there was no cost to removing cash from companies. And 3, it wasn't politically sustainable to be saying, well, let's just let the wealthy off the tax on their dividends, even though you had a 35% corporate tax rate. So it was a bit controversial, that. So we got to the new South Africa, and Barent du Plessis, remember, retired hurt after his fight with J. Naidu over the implementation of value-added tax. Once VAT was in, Barent said, fuck this for a lock, and he was out of the door, and we got the new Minister of Finance, Derek Keys. He was head of GenCo at the time, didn't have much better else to do, so he came in as Minister of Finance, and he dealt with it by bringing in the implementation of STC in 1993. The very first thing that you learn from it is the desire to recover your dividend tax, not from all the shareholders, but from the company. They don't want to chase everybody down, as they did with the partial taxation of dividends. And in that respect, STC has worked. But there is an inherent flaw in STC. And this is what causes the change. STC is a tax charge on a company, not the shareholder. So it hits your earnings per share. And for the individual investor, whether he pays the tax in the company or the tax in his own name really doesn't make much consequence, but it has an enormous consequence for the international investor. Because the international investor says, hang on, what you've got is a situation where you take 100 Rand revenue profit, less 28 corporate tax, 72 distributable, but if I distribute, I pay 6.6 STC, leaving me with an effective tax rate in South Africa for a foreign investor of 34.6%. And then they say, once I get the dividend home, it cannot be credited in a dividends tax computation abroad, because it's a tax on the company, not a tax on the shareholder. So it's not recognized overseas. It's only otherwise seen in Estonia and India. It's a very rare form of tax, this. And it is not recognized in terms of any of the double taxation agreements. So they don't like that, and they start jumping up and down. Now, you will remember that this was looked at in 2007 when Mbeki was still in power. And Mbeki and Manuel were hell-bent on impressing the international investor. They were probably more hell-bent on the international investor than they were on the local investor. So they said, okay, we'll change it. And what the overseas investor wants is to say 100 Rand revenue profit, less the tax, 72, distribute but no tax on the company, take 72 to the shareholder, but then impose a dividend tax on the shareholder, which can then be recognized in terms of double taxation agreements and used in the dividend tax imputation computation. So it's very much something that is driven by the international investor. Other criticisms on STC is that we have problems in an intergroup situation where we declare a dividend from subsidiary to holding company. That can only be exempt if we're in the same group of companies as recognized in Section 41, i.e. a 70% shareholding, and we comply with Section 64B5, which says inter alia that the dividend's got to be paid out of post-acquisition profits. There's got to be a notification of SARS, etc. So let's say the intergroup position on STC is a little bit cumbersome. But the biggest change comes on retirement funds, and this I'm going to go on and on about. Because currently STC makes no inquiry as to the shareholder. It taxes indiscriminately. So where we go from company to retirement fund, there's STC implemented, no exemption. And they're saying, but we're trying to get South Africans to invest in a tax haven called a retirement fund, and yet we still have a form of retirement funds tax because we have STC on dividends. So you have the rather ridiculous situation that a retirement fund receiving interest, it's tax-free. Receiving a capital gain, it's tax-free. But receiving a dividend, it's paying an underlying tax. So they need to do something about that. And that's probably the biggest change as affects the individual shareholder in South Africa. Right. STC's current provisions are driven by the definition of dividend contained in Section 1 of the Act. Those of you who wrote the board pre-2011 remember that that was driven by what are the reserves of the company. We always used to joke that whoever wrote that definition had a tormented mind. Okay? Very complicated, looking at pre-1993 revenue reserves, post 2001 capital reserves, and all sorts of crazy stuff going on in it. That was your definition of dividend, which drove your charging provision in STC Section 64B. And then your deeming provision was contained in Section 64C. They couldn't wait to get rid of the definition of dividend. So the old definition of dividend stepped aside as being antiquated and was replaced 1 January 2011. So that's already done. We'll revisit it in this lecture and have another look at it. Then, with effect from 1 April 2012, we replace the charging provision and the deeming provision with new provisions from Section 64D onwards. So that's what we're now out to do. We go straight past Section 64D because that contains the definitions for purposes of dividend tax, and the charge is then levied in terms of Section 64E. you will see that 64B and C will have to remain there for a little while. Right. So 64E says there must be levied for the National Revenue Fund a tax to be known as dividend tax, to be calculated at the rate of 10% on the amount of any dividend paid by any company other than an international headquarter company. So that's great. That's nice and simple, straightforward charging provision. But the moment that you have to have a charging provision, you have to say, wait, there's something more to it. We have to say, what is the timing of the tax? When is a dividend deemed to be paid? And that's where they say, right, for purposes of this part, a dividend is deemed to be paid not on receipt or accrual, on the date on which the dividend is paid or becomes payable by the company that declared the dividend. Nice simple stuff in the first two charging provisions. So we say, right, we'll pay 10% over when we pay the dividend, or it's payable or claimable by the shareholder. So it's a simple 10% tax, and the problem now, we can start going into the nitty-gritty and getting clever. What is a dividend? And that's where you have to go back to the definitions which are contained in section 64D. So 64D, what's a dividend? A dividend means any dividend or foreign dividend. Wait. Notice they're treating dividends and foreign dividends the same. That's going to come up this morning a few times because in the past we did not have that concession. Remember, foreign dividends used to be fully taxable, and that's going to change. But we'll come back to that later, more about that later. So it's any dividend or foreign dividend paid by a company that is resident. And for most practicing CAs, the dividend definition stops there. For the nerds and CA candidates, it then continues. Or paid by a company that is not resident, if the share in respect of the foreign dividend is paid is a listed share, to the extent that the foreign dividend does not consist of an asset in specie. So the three blocks to the right there, unless you're dealing with foreign companies, you can go Control-Alt-Delete and you can just stay with paragraph A. It's nice and easy. But they still don't know what is a dividend. It just says a dividend is a dividend paid by a company that is resident. That's why it does a hospital pass now, and it says jump from D to section 1 to find out what a dividend is. We've basically got the charging provision thus far, but D was no use to us because it simply referred us back to section 1 as to what is the dividend. And this is where it gets a lot simpler than the old definition of dividend. We've now had for a year the new definition of dividend contained in section 1. And that says we have a general charging provision, which says it means any amount transferred or applied, not received or accrued, by a company that is resident for the benefit or on behalf of or in respect of any share in that company. Nice and simple, and then it extends it just a little bit, where it says, right, take that and extend it by way of distribution or by way as the consideration of for any share in that company. Simplify that down then to a routine dividend and a share buyback. Those are the two things that fall in the definition of dividend. So that's it. Then we come to the exclusions after that. Now, when we come to the exclusions, note they are the exclusions from the definition of dividend. That's one set of exclusions. We will later have the exemptions from dividend tax. That's another issue. So now we have to say, right, what do we exclude? We exclude the reduction of contributed tax capital, where we have the shares in a company or where we have the repurchase of securities. Items 2 and 3 are not that common. The most common one in practice is the reduction in contributed tax capital. So what we have to do now is we have to go and say, right, it's 3 items that we've got there. That's return of share capital, share repurchase, and securities repurchase. We now need to go in there and say, what is contributed tax capital? And contributed tax capital starts to get a little bit hairy, but we must weed it down to what is significant. The contributed tax capital of a company is also defined in section 1 of the Act, and it says, there are provisions for a company that was not resident but became resident on or after 1 January 2011. There's a provision for the nerds to go and analyze to death. And then there is item B, which is for any other company, which is what's going to affect the daily life of a practitioner in South Africa. Just to show you what the difference is, not that you're ever going to really encounter it in practice, let's just go and say it breaks it down into non-resident companies and resident companies. In non-resident companies, it says, on the day that you come to South Africa, you value all the shares in the company. The reason that you do that is that we don't know what's in the share capital of your company, so what we'll do is we'll simply value it. And then we'll add to that any amount or any consideration received for the issue of shares after they came to South Africa, less any amount transferred back to the shareholders after they came to South Africa. So that's actually not that complicated, but in any event, it's probably not going to happen to you in practice anyway, because it's not dealing with a non-resident company. When we deal with a resident company, we say, right, on resident companies, we look at the stated share capital and share premium. Notice this is quite old, it's still got share premium. We don't talk about share premium anymore. Okay, it's the stated capital of the company. Before 1 January 2011, adjusted for any amount that may be in share capital that would have constituted a dividend had it been distributed by the company immediately before that date. So that would be the reserves that you have capitalized in one way or another. And then what you'll do is you will add to that the consideration received after 1 January 2011, reduced by any amount transferred back after 1 January 2011. And that will deal with your distribution of share capital, your reduction of share capital. So what we've done so far is we've looked at the definitions. We now go back to the charging provision in 64E because it goes further. And stay awake now, because in item 3, we identify one of the crucial factors in the new dividend tax. And that is the definition of a dividend, where we have a dividend where it is a distribution of an asset in specie. And it makes, at this stage, a distinction. It says, if there is an asset in specie, the value of the dividend will be the market value. So that looks pretty much sensible. 64.3 E3 then goes further, and it says, if an asset is distributed by a listed company, then the directors or a body of similar authority will perform a valuation of the assets distributed. And it goes even further, and it says, if we are dealing with an unlisted company, then we will value the asset as prescribed in paragraph 74 of the 8th schedule. You might remember the 8th schedule is capital gains tax. There are some anti-avoidance provisions in assessing market value contained in paragraph 74 of the 8th schedule. I'm not going there now. You would have a look at that off the capital gains tax guide, which you can download for free off sars.gov.za. Now, important, why are they making that definition? And the reason is, we'll see in a moment, that they tax any distribution of an asset in specie in the hands of the company making the distribution, not in the hands of the shareholder. There's an allergy in this legislation against dividends in specie. Item 4 is great news. You might have remembered from last year that we were going to get a thing called value extraction tax to replace the deeming provisions of section 64C. They went Control-Alt-Delete on value extraction tax. They took it out. And what they replaced it with instead is 64E4, which says you will have a dividend if there is a loan or advance to a person that is not a company, who is resident, and is a connected person in relation to the company. And then it carries on further. The company must, for purposes of this part, be deemed to have paid a dividend if you've made such a loan or advance by virtue of that share. So what we see is that 64E4 is the driver that takes over from 64C in the main part to deal with loans. But there's an essential difference between this provision and the old 64C, because when we come to assessing the quantum of the distribution when we've made a loan, it goes to the greater of the market-related interest on the loan, less any amount of interest that may have been paid, subject to the greater of nil, i.e. we can't create a loss. Now remember, under 64C, it was the entire loan account became subject to STC. Now we've only got the benefit that you're actually receiving. And there's some people who are saying, gee, this is quite interesting. If I pay a bonus to a shareholder who's in super tax, they'll pay 40%. If I make a loan to an employee who's a shareholder, they'll have a fringe benefit in terms of the 7th schedule, which is calculated at the official rate of interest. But if I make a loan to a shareholder, I take the official rate of interest and then only have a tax at 10% on the official rate of interest. So, if I go tax the income in the company, then advance a loan, I've got 28% plus 7%. Okay, it will revisit you next year, but you've got a full-on discount if you advance funds by way of loan account, which might be quite useful if you are short of tax cash when we are trying to get money to shareholders. So there's a tax planning opportunity inherent to 64E4 and a fundamental difference from old section 64C. 64E4 then continues, and it then gives you the timing of when you are deemed to have made a dividend. That's on the last day of the financial year. And then in item D, it says to pick up the market-related interest rate, you will go to the official interest rate as defined in paragraph 1 of the 7th schedule, i.e. your fringe benefits tax legislation. 64E5, very simple. If you have a foreign dividend, you will convert it to rands by applying the spot rate on the date that it is distributed. So, at this stage, that's how we have a dividend. But now the question is, who's going to pay the tax? And this is where section 64E cap A is of critical importance. Because watch what it does. It says, the beneficial owner of a dividend pays the dividend tax. However, this rule does not apply if we have a distribution of an asset in specie. Then immediately in B, where the company is resident and it pays a distribution of an asset in specie, the company will pay the tax, not the shareholder. Okay? Now that's an absolutely critical distinction between a routine cash dividend and the distribution of an asset in specie. And one must always be aware of that. That's a fundamental inherent to dividend tax. I'm sure if I was setting the board exam next year, that's something that I would want to have a look at. Now we go to F. F has got the exemptions, and it runs like this. There will be an exemption on dividends paid in cash. Notice again, it excludes dividends in specie. If we have a distribution to a company which is resident. Please, not all companies are covered. You have to be resident. The moment that the dividend goes over the Limpopo, the withholding tax has to be applied. It might be at a reduced rate, but only local resident companies receive exempt dividends. Notice, importantly, there is no shareholding requirement. That's critical. Any company-to-company dividend exempt. Then they continue with the logical ones, government, provincial, and municipalities. Then they add in public benefit organizations approved by the Commissioner. Notice, approved by the Commissioner. If you haven't had your PBO approved, you can't claim the exemption. D is rehabilitation trusts, That's for minds, not drunks. Okay? And E is any institution, board, or body under 10(1)(ca). So SICA used to receive tax-free STC levied dividends, will now go to dividend tax exempt dividends, and their return will go up by 10%. Nice. You might say there's nothing in this for the individual, but the next one is situation critical. And this is where we have to completely reassess our financial planning. We have an exemption where we have a distribution to a fund contemplated in 10(1)(d), that is pension funds, retirement annuity funds, and provident funds. Currently paying STC, from the 1st of April, they will be exempt. Now, I calculate that as being a benefit to the retirement industry of about 5 billion rands a year. It's absolutely substantial. And we need to get out there with our clients and show, hang on, there's something we need to analyze in this. Because if I go out and buy a collective investment scheme in my own name, that's a unit trust in layman's terms, right? We're buying it out of after-tax income. The interest can be taxable if you are over your abatement. You're going to pay capital gains tax on disposal. Then you're going to pay dividend tax on the dividend receipt that you're getting. On top of that, if you die with a unit trust in your own name, it could be subject to both CGT and estate duty. So we say, right, instead of buying it in our own names, we buy it through a unit trust. And straight up front, a tax deduction of up to 40% on investment. Remember that the 200,000 Rand cap of NRFI and contributions to RAs never happened in the budget. It was announced in the budget, it never came through in the legislation. So you invest into retirement annuity funds with a discount. Then all your growth within the fund is exempt from tax on interest, tax on dividend, capital gains tax. And then if you die, there's no CGT, and the value of your retirement annuities is no longer put into your estate duty computation. That is the best tax benefit we've seen since we used to play in Guernsey, right? But now it changes. People say, no, but when I draw it out, it will be a taxable annuity. So I say, well, yeah, okay, fair enough. But then when you retire, you can determine the timing of the drawdown of an annuity to a certain extent, and you will have no income from employment. So your average rate of tax should be a hell of a lot lower than what it was. Also, you will see that certainly for the time being, the portion that you draw down from the RA to fund your medical will be deductible. That's still in existence. So we're not going to pay that much tax when it draws down. Now, to try and illustrate this to people, we say, well, what does the advertising industry show us about retirement? And every ad that we get about retirement has got happy grey people riding surfboards and going parachuting. It looks like a Viagra advert. I mean, it's just ridiculous, okay? What we should be doing is saying to them, the reason you use an RA is you're probably going to double your money. So we need to, what we're developing for the budget is a little Excel app for that, where we say, if I invest in an RA, I'll get so much after 20 years. If I invest the same amount in the same product in a unit trust, I'll get so much less. So that would be a reason to watch the WebEx over the budget. Then we get a person's contemplated in 10(1)(t), and micro business, they're not so substantial in numbers. They're a bit obscure. You can leave those for the board exam. Item I deleted. Now when you go to the exemptions on dividends in specie, now it changes. Notice we can't go to F for the exemption, we have to go to FA. And FA only really gives one big exemption. It says where we are distributing an asset in specie in a group of companies defined in section 41. So that would be a 70% shareholding requirement, no less. The only other exemption is where we are distributing a property company in terms of paragraph 51A but of the 8th schedule, but very, very few people are doing that. So we really only have the one major exemption. And then if you do that, there's a whole heap of disclosure requirements. I'm not going to read them to you, that say you have to come and make a great big declaration to SARS about any dividend in specie that you may have pushed up a group of companies. And that's contained also in 64FA. Moral to the story, keep away from dividends in specie. You're going into hot water if you go down that route. So, in the first half hour or so of this lecture, what have we looked at? Dividend tax at 10% and the distinction between loans, dividends in specie, and cash dividends. Now the question comes, how do they pay it? The recovery provisions.